Hey, thank you for taking the time to click on today's video. As you age and you get older, you begin to think about end of life. You begin to think about what's going to happen if I pass away. And this is a good thing. When mortality begins to set in, it also kind of prioritizes our life. It forces us to take stock of what's going on in our financial life and make certain that we've got our financial household in order. But one of the things that many of us carry in our life or on our life is life insurance. And I get a lot of questions from week to week from many different people that are asking about life insurance. Now, life insurance very simply is something that I believe most all of us need to have. It's something that allows our beneficiaries, whether that be our spouse, our children, or grandchildren, to be able to have some immediate cash when we pass away. Generally, if all things work out well, that family member is going to be able to have a tax-free check in their name within basically about 2 weeks after death. But the reality is this, that it's the policy that we want to take care of. Now, policies come in many different forms. Generally speaking, you can have term life insurance, and term life insurance is temporary insurance. We're buying it in small increments. Maybe it's a 10-year term, maybe it's a 15-year term, a 20, or maybe even a 30-year term. But generally speaking, most of us that age into our 70s and our 80s and pass away that have life insurance, the form of life insurance that we have is permanent life insurance. Now, permanent life insurance is, well, it's just a name, it's just a title. And we have to make certain that we're taking care of our life insurance. Otherwise, that life insurance might actually run out before we actually pass. And so I want to give you some basics. Now, understand that there's many different varieties of permanent life insurance. You could have whole life insurance. You can have variable life insurance. Today we're going to be discussing in particular probably the most popular form of permanent life insurance, and that's universal life. Now, behind me what you see is a bit of a graph, and we're going to develop this as we continue our conversation today and we learn about our permanent life insurance. But what we want to understand is that life insurance is something that could be started on a child that's 15 days old. It can be something that could be acquired on a person who's quite late in life. But we're going to start at the beginning. We're going to say that this is a juvenile life insurance, and we're going to notice that at this point, the cost of insurance, this little blue line here, is very, very low. This is the internal cost that the insurance company is charging you to provide the $50,000, the $100,000, the $1 million of life insurance that you have on your life. Now, bear in mind that every time that you have a birthday, every single time that you age, that cost of insurance is going to go up. And it's going to look a lot like this. That cost of insurance is going to continue to increase. It's going to continue to get bigger because the insurance company is taking and they are compensating for how many fewer years you have left to live. In other words, the insurance company is wanting to make as much money on you while you're still alive and you're able to pay a cost to them for providing the protection. Now, you may be thinking to yourself, but wait a minute, Matthew, I have a premium, and my premium that I pay every single month or every single year for that life insurance policy has not changed at all. And that would be absolutely correct. You see, when you apply for life insurance and you get that life insurance approved, that life insurance starts out with a cost that is based upon your age. So let's just say that you bought this policy right in the middle, you were 25 years of age. Well, your cost of premium is going to start somewhere around here. And that premium that you pay on that life insurance policy, in theory, is going to remain identical. It's going to remain absolutely the same. Now, the reality is that at some point in your future, you're going to realize that the amount of premium that you're paying into your life insurance policy is no longer adequate. And so we need to back up the train and just consider something. You see, from this point forward to this point, you notice that you were paying a lot more in premiums than what the actual cost of insurance was. And what that means is that your policy from this point to this point is building up what is referred to as cash value. Now, is that a good thing? Well, it is a good thing. Oftentimes, I find that financial advisors, however, insurance agents, they really do a good job of dressing up a life insurance policy, getting you to believe that all of this abundance of cash value is going to be very valuable to you. Well, you can take it out and you can send your kids through college. You can take this cash value out and you can use it to buy a new retirement home, so on and so forth. Now, I'm not going to argue that that can't be done because the cash value is yours. It's available. You can take it out as a withdrawal. You can take it out as a loan. But let's just suggest that you bought this life insurance policy for its intended purpose, and that is to provide tax-free death benefit. What's going to happen is because you are paying more than what the cost of insurance is actually charging you, that means that your cash value at this point is going to continue to grow until it reaches this point right here. Notice that there's a bit of a convergence that takes place. Our cash value is growing, our cost of insurance is going up, but at this point right here, this now is a whole change of events. You see, what happens is our cost of insurance is now exceeding our premiums, what we're paying into the policy. So then that asks or begs the question, what happens to my cash value? Well, at this point, this is the reason you want the cash value, because now the cash value is going to be compensating for the cost of insurance that you're not covering through your premium. Now, one of the things that I really wish to stress is that for many of you, you bought your life insurance policies maybe back in the 80s. Maybe you bought your life insurance policy in the 90s. And we must understand the environment at that point was a very high interest rate environment. So what has happened over the course of time is many of these life insurance policies have reached a point where they are not performing well at all. In fact, that premium that they asked you to pay was even lower. And why is that? Because the insurance agent, the company that you were with, even maybe yourself, you convinced yourself that while your policy was making 8%, 10%, maybe 14% interest during those 80s and 90s, why you don't have to pay much in premium. You can pay way down here somewhere because this interest rate is going to compound that cash value. Your policy is going to be self-sustaining at some point in the future. Maybe you get here and they say, don't worry about it, Mr. and Mrs. Client. You can stop paying your premium. You'll have sufficient cash value to carry this policy all the way to age 100. Well, unfortunately, that's not what happens in probably 80 to 85% of the cases that I see. So what we want to do is we want to pay particular attention to the health of our life insurance policy. We want to make certain that we're paying attention to that increasing cost of insurance. We want to make absolutely sure that the premium that we're paying into our policy is sufficient to not only cover the cost of insurance, but is sufficient to build up enough cash value so that sometime in our future, we can indeed stop paying premiums and have sufficient cash value to carry this policy all the way to age 100 or whatever age that we feel comfortable in. Now, how does a person really know this? Well, I'm going to give you two tricks. The first is you actually have to read your life insurance annual statement. Now, on most life insurance policies that are going to be permanent, that are going to be universal life, most insurance companies put it right there in black and white that if you continue to pay your existing premium, what you're paying right now, your policy will last until a particular age or until a particular date. You need to look and scour your annual statement to pay attention to look for that statement. Number two, let's say that just by chance you couldn't find anything on your statement that indicated how much longer your policy is going to last. Because of course, remember, you bought this for protection. You don't want to outlive your life insurance. You want your life insurance to outlive you. Well, here's something that you're going to need to really be responsible for getting. What you're going to order is what is referred to as an in-force ledger. And that in-force ledger is something that you can ask your insurance agent for. This is something that you can ask the insurance company for. You can call directly into the insurance company. You don't need your agent. And you can ask for an in-force ledger. And what is that in-force ledger? It's like taking your life insurance policy and hooking it up to an EKG machine. And when you do that, it shows the health and the projection of where this policy is headed. Now, I want to say this. The goal here is never to run out of life insurance. But so many people think that the goal is to die with a lot of cash value in your life insurance policy. That is absolutely false. In fact, if I could arrange it magically that every one of my clients died with $1 of cash value in their life insurance policy, I'd be a happy man. And the reason being is we must remember that when we die, our family gets the death benefit. They don't get the cash value. And that means that you're essentially forfeiting the cash value. So let's say, hypothetically, you have a $150,000 life insurance policy, and it has, we'll say, $75,000 of cash value in it. When you die, your family is not getting $225,000 of death benefit. They're still only getting the $150,000 of death benefit. Well, what happened to the $75,000 of cash value, Matthew? Well, that stayed with the insurance company. So it is a very tight line that we are walking. We want to make certain we're paying adequate premium to keep our policy in force for as long as we live. We want to make certain that we're building up cash value so that sufficiently there's enough cash value in the future that we don't have to continue to pay premiums until we die. We're alive, but we can stop paying premiums and let the cash value take over and carry the policy. We want to make certain that we haven't developed an overabundance of cash. And the reason being is, guess what? We forfeit that cash value when we die. And if there's an overabundance of cash value, it means that we've overfunded the life insurance policy. We've actually paid too much into the contract. So remember, the health of your life insurance policy is extremely important. Hopefully this gives you a little bit of a visual to understand what happens mechanically in your contract and realizing that your life insurance policy is truly your responsibility. This is the reason why every, say, 4 to 5 years, you want to order an in-force illustration. You want to look at the health of that contract and make certain that you're tweaking it, you're adjusting it so that that policy survives. Now, one last thing before we end. Let's say that you realize all too late in life that there's some issues with the life insurance policy. In fact, that cash value hasn't reached this point. It's already started to come down here, way too prematurely in your life. What can you do? Well, you can take and reduce the cost of life insurance by simply reducing the amount of death benefit that you have. I often find that individuals that are older, they don't have the health, they can't switch policies to a less expensive policy. And so they want to keep the insurance, but they just know they don't have the capital to pay a bigger premium. They realize that they just simply are going to run out of cash value. The policy is going to implode before they do. So what we do ultimately is we reduce the death benefit on that life insurance policy to alleviate the strain to that cash value. Having something is better than having nothing. And by reducing the death benefit, you reduce the cost, you allow the cash value to carry that policy for a longer period of time, giving you a better chance of being able to maintain the protection on your life for that of your family and your loved ones. I want to thank you for watching today's video. Hopefully this has given you a little bit of education. It's given you a little bit of maybe encouragement to take responsibility for your own life insurance policies. If you like our little videos, I encourage you, give me a thumbs up. That always helps. If you like our videos, hit the subscribe button and ring that little bell. We will notify you every time we have a weekly video. And I encourage you, share this with your friends. Give us comments down below. That helps as well. Thanks so much for watching. I'm Matthew Johnson, and remember, it's up to you to make today a great day.